Hello everybody, and thank you for joining this Focus Economics webinar on the MENA economy, past and future. This webinar was prepared by Focus Economics lead economist Ricard Tourné and Focus Economics economist Oliver Reynolds. This webinar will assess the economic developments in the Middle East and North Africa region from the year 2000 to the present day, and looks ahead at what is in store for the region over the coming years. It will primarily examine how crude oil has shaped the economy and discusses the current panorama in the oil market. The webinar will conclude with the MENA economic outlook from the Focus Economics Consensus Forecast. So before we get into the actual content of the webinar, I should tell you a little bit about Focus Economics. Focus Economics has been providing reliable and insightful economic intelligence since 1999. We provide consensus forecasts and analysis for more than 130 countries across 5 regions and more than 30 commodities. Over 1,000 trusted international and local economic analysts at leading institutions contribute their forecasts to our consensus each month. If you'd like more information, please visit our website at www.focus-economics.com. So before beginning the webinar, we should probably start with a quick definition of the Middle East and North Africa region, which is defined as the area that extends from Morocco in the west to Iran in the east. This webinar will mostly refer to the region as a whole. However, it is of course important to bear in mind that the impact of regional and global events can differ greatly from one country to another, given the vast geographical area and the enormous political, social, and cultural diversity across the region. Having said that, we can begin the webinar, and we'll start by taking a look at MENA's nominal GDP and GDP growth versus the world. Regional nominal GDP has nearly tripled since the year 2000 in US dollar terms, but is still marginally below the peak reached in 2014 due to the fall in world oil prices observed since then. The region's share of global GDP has followed a similar trend, jumping from slightly over 3.0% in the early 2000s to around 4.5% at the height of the commodity supercycle before easing off to around 4.0% today. GDP per capita was roughly $8,000 US in 2018, according to preliminary estimates, although this masks huge regional disparities, with the figure for oil exporting nations more than double that of oil importing nations. Among Gulf Cooperation Council countries, Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the United Arab Emirates, GDP per capita in 2018 was over $28,000 US, close to that of developed nations. Relative to other emerging markets, MENA's economic performance since 2000 has been middling. According to Focus Economics data, both the Asia ex-Japan and the sub-Saharan Africa regions have seen real GDP expand at a faster rate than MENA, while Latin America and Eastern Europe recorded slower growth rates. The Triple Crisis was a series of 3 events between the years 2009 and 2016 that rocked the MENA region and consequently heavily impacted many of the economies in the region. In the first decade of the 21st century, buoyant prices for hydrocarbons, the region's primary export, propelled growth in MENA. The relentless flow of petrodollars allowed governments to spend lavishly, transforming infrastructure and cityscapes across the region. A rapidly growing domestic market, which spurred demand for goods and services, also powered growth. This period was followed by some severe turbulence. First, in 2009, the global financial crisis rocked the MENA economy, with GDP growth falling into a multi-decade low. That said, the shock was comparatively short-lived since the region received a boost from the massive stimulus programs unveiled by China and the United States. Then came huge political upheaval after a Tunisian street vendor set himself on fire on December 17, 2010, in protest to the authorities confiscating his wares. This event first sparked the Tunisian Revolution, before spreading across the region as latent public discontent over poor living standards and repressive politics suddenly erupted within several MENA countries. Social media fanned the flames, with widespread public protests and armed uprisings culminating in the ousting of some of the long-lasting authoritarian regimes in the region. The Arab Spring caused economic conditions to deteriorate sharply in 2011 in Bahrain, Egypt, Libya, Syria, Tunisia, and Yemen. Tunisia's GDP contracted, growth in Bahrain and Egypt slowed to multi-year lows, and the economies of Libya, Syria, and Yemen collapsed amid political and social instability. However, high oil prices and large fiscal stimulus in regional heavyweight Saudi Arabia supported MENA's economy in the 2011 to 2013 period, despite persistent political uncertainty plaguing the panorama. The third shock came in mid-2014 as oil prices began to decline in the context of excess oil supply. Despite rising global production, OPEC countries decided to retain their market share in an attempt to undermine the rampant but more costly oil shale industry, mostly located in Canada and the United States. Moreover, oil prices were negatively affected by slowing global growth. The global oil glut put pressure on oil export-driven economies in the region, and the impact on MENA's economy was compounded by a number of more localized events. For instance, Iraq and Yemen became embroiled in civil war, while Lebanon was hampered by political uncertainty. That said, the lower oil prices supported the economic performance of oil importers by reducing price pressures, thus cutting firms' costs, and boosting consumers' purchasing power. Traditionally, countries belonging to the Organization of Petroleum Exporting Countries, also known as OPEC, which produce around 40% of the world's crude oil, have acted as a buffer against sharp swings in oil prices by tweaking production accordingly. Nevertheless, in response to the collapse in global oil prices, OPEC countries initially maintained their existing quotas of around 30 million barrels per day instead of adjusting production to stabilize oil prices. This move was intended to retain their market share at the expense of lower revenues and aimed to price higher-cost U.S. shale oil producers out of the market. Yet, the USA's resilient shale oil production prevailed despite being hit by low oil prices, owing to substantial operational and efficiency gains. Exacerbated by faltering global demand, consequent oversupply in the market caused oil prices to plummet, hitting rock bottom in early 2016. With its strategy of forcing more expensive producers out of the market failing, OPEC changed tack in September 2016 and agreed to the first production cuts since 2008. Even non-OPEC nations, such as Russia, also pledged to trim output, although Iran and Libya were exempt from the deal to allow their domestic industries to recover. This 6-month pledge was then extended in May 2017 and again in November 2017. In contrast to past attempts to curb production, compliance was high this time around, with Saudi Arabia and other Gulf countries shouldering a large part of the burden. As a result, the cuts achieved their primary aim of clearing the supply overhang. Oil prices thus climbed to multi-year highs in mid-2018, despite still being substantially below the heady days before the 2014 crash. However, under intense pressure from the U.S. and amid concerns that the resumption of U.S. sanctions on Iran in November 2018 would lead to shortages, OPEC flip-flopped on policy in June 2018 and promised to boost output. Consequently, between June and November, most OPEC producers, with the main exceptions of Iran and Venezuela, ramped up production to keep the market well supplied. As a result, Donald Trump's surprise announcement in early November of waivers for some Iranian oil exporters, which provided a lifeline to Iran's oil industry, turned the market completely on its head. Prices tumbled, undoing in one fell swoop much of the progress OPEC had made in previous years in stabilizing the market. The pendulum has therefore now shifted once again. In December, OPEC and its allies reinstated production cuts covering the first 6 months of 2019 to support prices, which has led to a rebound in oil prices so far in 2019. Moreover, in late April, Trump signaled the end to Iranian waivers from the 1st of May, which will cripple Iranian oil exports, restrict supply, and should add upward pressure to prices. Despite lower oil prices, growth among oil exporters held up fairly well in 2014 to 2015. This is because years of high oil prices had enabled countries to build up sizable fiscal buffers, which they were able to draw on to boost government spending and support the economy. However, growth tailed off fast in 2016 and 2017 as fiscal stances became less expansionary and oil production cuts were implemented, before lightly picking up in 2018 thanks to more fiscal support. Meanwhile, oil exporter Iran should be treated as a separate case. The Iranian economy surged in 2016 following the signing of the nuclear deal, as sanctions were lifted and FDI inflow surged. However, the snapback of U.S. sanctions in 2018 has ravaged the oil sector and likely pushed the economy into recession. Following the oil price crash, oil exporters have placed greater emphasis on diversification in order to reduce dependence on oil. These efforts are epitomized by Saudi Arabia's much-publicized Vision 2030 plan, announced in early 2016, which seeks to turn the kingdom into a global hub for investment and trade. However, oil exporters have only had limited access thus far and remain overwhelmingly reliant on hydrocarbons, and, as such, at the mercy of events in the oil market. The UAE, which has several other strings to its economic bow, such as tourism, retail, and business services, is a notable exception. Among oil importers, economic momentum has been largely steady in 2014 to 2018 compared to the previous 5 years, despite the boon provided by lower oil prices, due in part to a series of domestic challenges faced by many countries. Jordan and Lebanon have both been affected by spillovers from the Syrian civil war, which reduced tourism inflows and put pressure on public finances. Tunisia has suffered from political and social instability since the 2011 revolution. Morocco has been hit by severe drought, and Egypt has grappled with a calamitous fiscal situation and a lack of competitiveness, which eventually led to an IMF bailout in November 2016. On the fiscal front, most oil exporters went from racking up huge budget surpluses in the years prior to the 2014 crash to experiencing gaping deficits. The fall in oil prices laid bare the inadequacies in many nations' tax systems, which had an extremely narrow base and were overly reliant on hydrocarbon revenue. As a result, fiscal reforms have gradually been enacted. Saudi Arabia and the UAE introduced a 5% value-added tax on the 1st of January 2018, and Bahrain followed suit at the start of 2019. While excise taxes have been raised and costly public subsidies have been reined in. These reforms, coupled with a recovery in oil prices from their nadir in 2016, have caused the fiscal deficit among oil exporters to narrow sharply since 2016, stemming the rise in the public debt-to-GDP ratio. Moreover, in Iraq, the end of the civil war at the end of 2017 provided a boost to government coffers. That said, some countries have been reluctant to carry out fundamental fiscal reforms. Most notably, Kuwait, Oman, and Qatar have postponed the introduction of VAT. In the case of Kuwait and Qatar, their healthy budget balance and low break-even oil price makes additional revenue-generating measures less urgent. However, the non-implementation of VAT in Oman, which is burdened by a hefty budget deficit and rising public debt, could have more serious consequences for long-term fiscal sustainability. As of yet, Bahrain has been the only major casualty of the 2014 oil price slump. The Gulf nation was forced to ask for a $10 billion bailout from its GCC neighbors in 2018. A combination of high public debt, weak fiscal metrics, and low international reserves have led some investors to question the sustainability of the currency's dollar peg. Iran, meanwhile, has bucked the overall trend. Reintegration into world markets enabled it to boost oil output for 2016, offsetting the fiscal impact of low oil prices. However, the budget deficit is now on the rise again due to the impact of sanctions. Turning to oil importers, the budget deficit fell slightly from 2014 to 2018, thanks largely to fiscal consolidation programs in Egypt, Jordan, and Morocco, in conjunction with the IMF. However, the shortfall remains sizable, and fiscal metrics in Lebanon remain dire against the backdrop of political fragility. MENA's current account position has followed a similar trend to the fiscal position. The double-digit current account surpluses enjoyed at the height of the oil price boom turned into current account deficits in 2015 and 2016 as oil revenue fell, eating into the region's international reserves. However, the current account is now back in surplus, with a surplus among oil exporters more than offsetting a deficit among oil importers. Furthermore, with the exception of Bahrain and Yemen, MENA economy's international reserves provide sufficient import cover. While oil is not 100% responsible for growth in all of the MENA countries, the evolution of oil prices greatly determines growth prospects in the region. Therefore, it is important to analyze the current situation in the oil market to get an accurate picture of the region's economic outlook. Panelists in our latest Commodities Consensus Forecast report see oil prices remaining fairly close to their current level going forward, as OPEC's agreement to cut production coupled with lower supply from Iran should help support prices. Our latest Commodities Consensus Forecast report projects Brent crude oil prices to average $67.9 per barrel in Q4 2019 and $67.1 per barrel in Q4 2020. WTI crude prices are expected to follow suit and average $60.7 per barrel in Q4 2019 and $59.9 per barrel in Q4 2020. Several downside risks to prices are present. Concerns over global growth persist, with signs that many developed economies have lost steam. Moreover, if oil prices begin to see a sustained rally, the U.S. could put pressure on Saudi Arabia and OPEC to boost supply as it did in 2018. In addition, U.S. shale production is set to expand further, lifting total U.S. crude production to 12.5 million barrels per day in 2019 from 11.0 million barrels per day in 2018, according to the U.S. Energy Information Administration. This should offset some of the impact of lower Iranian supply. MENA's 2019 growth outlook has been downgraded substantially since mid-2018 in light of the Q4 oil price tumble and weaker global growth prospects. That said, oil exporting economies will be supported by infrastructure development, supportive fiscal stances, and reconstruction efforts in Iraq. However, the contraction in Iran will deepen as sanctions bite. Oil importers are seen growing substantially faster than oil exporters thanks to their broader economic base and ongoing strong momentum in Egypt. Our panelists now expect the MENA region to expand 2.0% in 2019 and 2.8% in 2020. Looking further ahead, although MENA should gradually gain steam, the rapid growth before the triple crisis will not return. Within the region, the growth disparity between oil importers and exporters will likely persist over the forecast horizon to 2023. Structural reforms should boost the economic prospects of importers such as Egypt, Morocco, and Tunisia, while exporters are set to expand at a mediocre pace. The region's fiscal metrics should improve thanks to gradual reforms. However, high oil prices could reduce the political appetite for such measures, and public spending will likely remain lavish to quell potential social unrest. The region will continue to grapple with several key challenges. Youth unemployment, which is over 25%, is painfully high. Compounding matters, the population is set to increase by around 40 million over the next 5 years. As a result, providing jobs for young people currently out of work and those expected to join the labor market in the coming years will be crucial to boosting economic growth and ensuring social stability. Moreover, the female labor force participation rate is the lowest of any world region. Boosting the number of women in work would be a surefire way to enhance economic prospects. In addition, many countries in the region remain highly reliant on hydrocarbons and vulnerable to volatility in commodity prices. Moving towards a more diversified, knowledge-based economic model will be key to ensuring sustainable growth. High public debt will be a concern in economies such as Lebanon, Jordan, Bahrain, and Egypt, while the future of Iran sanctions will have an important bearing on the region's economic performance, given the relative size of Iran's economy. Finally, MENA is likely to remain the globe's political powder keg. Geopolitical tensions between Qatar and its Gulf neighbors, Israel and the Arab world, Iran and Saudi Arabia, and lingering conflict in Libya, Syria, and Yemen will undermine growth prospects. With all that said, MENA's vast oil wealth is an asset which other global regions lack. If invested wisely, this wealth has the potential to transform the region's economic fabric, creating high-skilled jobs and boost the quality of life of its citizens. The Middle East and North Africa region benefited significantly from the commodity supercycle of the last decade, which allowed MENA to outperform other regions in terms of growth and helped it to build up a massive fiscal buffer. The countries that benefited the most during this time were oil exporting nations within the region, but the rest of the economies in the region recorded healthy expansions due to stronger shipments of other commodities, financial aid mostly from GCC countries, and robust private consumption. The strong growth recorded earlier in the decade came to an end in 2009 when the global financial crisis crippled economic dynamics in the region. While MENA began to recover from the crisis fairly quickly, the region was hit once again as the eruption of the Arab Spring jeopardized a sustained recovery in many of the region's key countries. While the Arab Spring was limited to only a few countries, the spillover effects reverberated across the MENA region. Finally, against the backdrop of rising oil production and faltering global economic growth, oil prices experienced a sharp fall starting in mid-2014, hitting oil revenue. While growth in 2014 and 2015 was propped up by fiscal support, austerity measures and OPEC oil production cuts weighed heavily on MENA's performance in 2016 and 2017, even as oil prices increased. 2018 saw a pickup in growth thanks to elevated oil prices in Q1 to Q3 and more expansive fiscal stances among oil exporting countries. MENA's fiscal and current account positions weakened considerably from 2014 to 2016, but have since recovered. In Q4 2018, oil prices collapsed amid elevated supply and signs of ebbing global growth. This has poured uncertainty on MENA's outlook and led FocusEconomics panelists to slash their growth forecasts for 2019. The economic performance this year hinges on developments in the oil market, where downside risks are present. Looking further ahead, MENA faces a series of challenges and risks, such as sky-high youth unemployment, low female labor force participation, a lack of economic diversification, heightened geopolitical tensions, and violent conflict. Yet the region's vast oil wealth still provides huge potential for economic transformation. So that concludes our webinar on the MENA economy, past and future. I'd like to thank you on behalf of all of Focus Economics for tuning in to our webinar. If you would like subscription information, please visit our website at www.focus-economics.com, or you may email us directly at info@focus-economics.com.